Welcome everyone on Concepts with Karan today, and I'm very happy and delighted to share that I have with me today Naveen Agarwal, the Managing Director and CEO of Motilal AMC. I can go on and on talking about Naveen, but I must tell you one thing that he is one person who spent close to 2 decades, almost 2 decades and more, with the Motilal Group in so many different leadership roles that it gives me immense pleasure to introduce him to all of you today. In his current role, he's the Managing Director and CEO of Motilal Mutual Fund. Naveen, I actually want to start with this first question by itself that you spent 2 decades with the group, and in this new role, you're in the fiduciary capacity. It's quite different from all the roles that you've had in the past. Something just to start with personally in some of the learnings that you've had over the last 2 decades and this new role, because like I said, it's fiduciary, very different from what you've done in the past.
Yeah, the 2 decades have actually been phenomenal. As you may recount, my journey here started 22 years back in the year 2000, and 2000 was one crazy year for the markets. And from there, we've seen a whole bunch of bull markets and busts that follow a bull market quite a few times over in my career. I think we've seen that from a stock market perspective, Karan. I think at Motilal, we've seen this from a business perspective also very closely. So we run retail broking business, institutional broking business, investment banking business, asset management, wealth management, private equity, and also now home finance business. So, seeing how each of these business evolves through the cycles. And as Buffett said, investing and business is joined at the hip. Good businessman becomes a better investor, and a good investor becomes a better businessman. I think that's really the journey of Motilal Oswal also, where we've tried to run our businesses using all our investing wisdom and use all our business wisdom to apply to our investing. And I think that flywheel continues to work as the firm finished 35 years, as Ramdevji finished 26 years of wealth creation study, and so on. So I think everything that you will see about Motilal Oswal is about decadal and not annual.
Absolutely. And I think it's quite phenomenal. I mean, the years that you've just spoken about, 35, 25, and you yourself at 22 years, the wealth of experience that you get after having experienced so many parts of the group, and now on the MF side, there is so much to gain for investors and distributors. Anything that comes to your mind to begin with that you kind of see that this whole transition of the 2 decades into the mutual fund business?
It's been amazing, actually. I remember that the only set of institutional investors that mattered 2 decades back was the foreign institutional investors. Okay. And I think, as you know, what has mattered in the last few years, as the share of household wealth in equities has gone up from 2.5% roughly to about 5%. Right, is that the domestic institutional investors are really coming of age. Really, SIPs, which are the alternative to 401k in the US, has really also shown remarkable, consistent growth, notwithstanding the volatility produced by COVID or any other volatility, right? And I think it is just a tip of the iceberg. See, Motilal Oswal is a play on the financial savings of India. And mutual funds are a play on that financial savings, as you know. So as I speak to you today, out of approximately 850 lakh crores of total household wealth in India, 50% is allocated to real estate, which is typically the first home, right? About 35% is allocated to fixed income, 10% is allocated to gold, and less than 5% is allocated to equities. About 4.8% is allocated to equities. This number may have doubled in the last few years, but compares with 45% in the US. So really, when we look at Motilal Oswal, we really strongly believe that to finish first, you have to first finish. And we may be a $3 trillion economy in the 75th year post-independence, but we are slated to be a $6 trillion economy by 2030, and then 12, and then $24 trillion, right? How many companies are going to be around at that time? And I believe that one thing that we want to do is that we want to be around them, and everything that it takes to be around is what we are doing. So we will never leverage, we will never speculate, We are founded on the twin pillars of knowledge and integrity. And I think all that holds us in very good stead to be around in 2030 and 2050, when this economy is manifold the size, and the size of the capital markets is even bigger exponential growth than that of the economy.
Yeah, I mean, I think that really makes so much sense in the way you explained it. In fact, one of the things that we've also seen over time with the group is the evolving expertise around managing money. It's something we just spoke about some time ago. It'll be very nice for you to explain to the audiences and to the listeners how that has evolved over time and how it could also evolve ahead. Considering we spoke about what companies may or may not remain in 10 or 20 years. So how has fund management evolved to cater to those needs?
So in the early 90s, honestly, we were like any other investor. I mean, owning a lot of stocks is the way we ran our shop. And then in the 90s came the introduction to Warren Buffett and the visit of Ramdev Agarwal to the Berkshire annual meeting at Omaha. And that gave birth to the first wealth creation study in December of 1996. And he has consistently visited Omaha after that, and he has consistently written these wealth creation studies after that. So I think the first stage of evolution was from being a very 100 stock investor to a concentrated portfolio. I think is something that we learned from Buffett. From buying anything to cutting out 90% of the universe and focusing on the 10% universe, which is quality companies, was the second part of the evolution, right? And I think during that journey, we collected a lot of frameworks. See, a lot of investors you will speak to will tell you that we buy good quality managements, running good quality businesses at a reasonable price. But I think that is 101. That is what they will teach you on the first day of an investing school, right? I think collecting investment frameworks, as Charlie Munger mentioned, over a period of time allows you the ability to understand an idea quicker, to hold an idea longer, and to be able to cut through the noise that typically surrounds the market all the time, right? So we have collected frameworks in every wealth creation study. And on the eve of our 25th wealth creation study, we put together a book called the QGLP checklist, where we put down all of these 25 frameworks. I'm happy during the conversation to share with you some of the fabulous frameworks that we've collected over a period of time. But one of the important milestones in our journey, Karan, has been when from being a mere quality investor, we added a G. So quality and longevity go hand in hand. You have to pay a higher than a market price for a high quality company with long, a runway for excess returns. But we added G for it to become QGLP about a decade back. And I think that became kind of the point where we launched our mutual funds. Focus 35 was born, was launched at an NAV of 10 rupees. And in a space of 4 or 5 years, became the industry leading product with a 30 rupees NAV and then double digit alpha generation every year. Our flagship PMS product, NTDOP, was the darling of the market and again generated huge alpha. Basically, all of that, the credit goes to the understanding of or the addition of G to the overall QLP. So I think that was a very, very important milestone. As we grew from, let's say, assets in terms of hundreds of crores to thousands of crores to 50,000 crores, right? And we believed in buy right, sit tight. Okay, we kept on holding the same stocks, which kept on going up in valuation, right? And as I said, our wealth creation studies are a reflection on a large opportunity ahead or a learning, based on our own investing experiences. And so came the 23rd wealth creation study 3 years back, where we, for the first time, put out guardrails on valuations for our investments, where we said that the probability of making money in stocks, if the PE is above a certain number, the PEG is above a certain number, is negligible. And so today we brought to that entire QGLP investment philosophy the rigor of monitoring, what is the valuation, and are we within the guardrails of the valuation that the 23rd study articulates. And this is not just at a portfolio level, Karan, it's also at an individual stock level. So I think there is a lot more mindfulness about the price at which we purchase, importantly the price till which we hold, and the price at which we start trimming our exposure. And so while we continue to pursue buy right, sit tight, and our average holding periods are long, but you will see us occasionally take profits as stocks go outside the boundaries of valuation that we've set for ourselves as an asset management company.
And so, which is comes as a direct result of the wealth creation studies and trying to put the guardrails so that you're able to exit stocks which you think perhaps may not make as much money as they've done in the past. So the point being, there is a constant evolution of how you're managing money.
Yeah, as I give you the example of Mercedes, the name of the car remains the same year after year, but the car is different, more contemporary year after year. I think these wealth creation studies really ensure that our investment philosophy remains contemporary year after year by making the necessary tweaks for it to be able to continue to generate alpha in the future.
So, just as an example of how this change has been brought about in actuality for the fund house and for, let's say, some of the portfolios, would you be at liberty to share a couple of examples of what you have done now would probably has something that you've not done in the past? Just as an example.
Yeah, so some of our top positions, particularly on the alternative asset side, ran up to as high as 15-20% of our portfolios, as we've seen. And typically, when does that happen, Karan? That happens when the stock has meaningfully outperformed the rest of the portfolio. Mm-hmm. And usually we've seen that these big outperformances come not just because of earnings growth, but because of valuation re-rating. Oh. And so those valuation re-ratings, which put the stock outside of the bounds of the valuation boundaries we've set for ourselves, in the last couple of years, you have seen us take profits. And in rare cases even exit where the valuations do not make sense. Mm-hmm. This is something that you may not have seen us in 5 years back, but this is something that you are seeing us doing in the current era.
Yeah, got it. And I just want to shift a bit of focus to the point you also made on how India would graduate in terms of the size of its economy. And in that perspective, managing money for onshore investors, Indian investors, and kind of then looking at the benchmark of the US, where it's 50% of household. In that whole journey, there are blips that come up, things like COVID and geopolitics, etc. But the overall journey, in your opinion, remains very, very solid. Any views around that?
So, see, the history of Indian markets from a point of view of a popular index called Sensex dates back to 1st of April 1979. It started at 100 points, correct? If you were to reinvest all the dividends reported by the 30 Sensex companies, right, then a crore rupee invested, Karan, in 1979, which is 43 years back, is worth about 800 crores today. The same crore, if you had invested in gold, would be 70 crores. And the same crore, if you had invested in bank deposits, would be 36 crores. But having said all that, we are still, as I spoke to you, we are at a $3 trillion GDP. Right. And the pace of our growth of economy, the pace of the growth of our corporate profits is likely to be very strong in the coming 6 to 8 years as India moves to a $6 trillion economy. There are only 3 countries in the world which have traveled this journey before us: America, China, and Japan. And at least the stock market history of America during this journey has been a compounded dollar return in S&P 500 of 15%. The history of China has been more spectacular because they had the investment and the consumption engine both firing. They traveled this journey in about 5-6 years' time, and they gave a return. The markets delivered a return of more than 30% per annum. We believe that India will take in between the time that China and America took, and our returns during this time period this once in a lifetime journey from $3 to $6 trillion could be also very strong double digit numbers. So yes, Sensex may have compounded for 43 years at 16%, including dividends, but I have little doubt that the next 8 years are as exciting as the previous 43 years in terms of even the pace of wealth creation. The size of wealth creation obviously will be a lot bigger because the size of the markets are much bigger, the number of PP accounts are much bigger, the number of retail investors participating in this market are many more, and the quality of companies, the diversity of companies that we have listed is a lot different. In fact, we have a lot more global players now. IT is a global sector. Manufacturing is set to emerge as a global sector in India with all the initiatives that the government has taken. So I think India luckily offers great entrepreneurs and a wide array of businesses to invest in, whether it is domestic or export oriented.
Yeah, and I think you make a phenomenal point on this whole journey, the doubling of 3 to 6 trillion, and that only 3 countries have reached there, and the possibility of India surely being up there, and that in a truncated time frame. I think the point you make and well taken is it's not necessarily going to be a 15-year time frame. In all of this, I think the role of advisors and distributors, Naveen, comes across very strongly because there is this whole concept of do it yourself. There's also the entire community around distribution and advisors. What is your take, both as the CEO of the mutual fund as well as an investor who's built businesses? What is your message to distribution and to advisors?
Actually, firstly, I must tell you that the mutual fund distributor community in India, the independent financial advisors, they have played a absolutely remarkable role in educating investors, and not just in the metro areas, Karan, but down to the hinterlands of India, the small towns, right? And because Motilal Oswal has clients all over the country, I can share with you that whether it is Northeast, whether it is a state like Bihar, right? Whether it is a small village in Rajasthan, right? I think these MFTs, these IFAs have really taken equities down to these small towns. And the quality of selling is something that has also been remarkable because I think they've taken SIPs down to each of these small places. See, at Motilal Oswal, we've seen the journey of retail investors trading in the stock markets and not creating wealth over a long period of time. I think exactly the reverse happens when these mutual fund distributors and IFAs work with these small investors to educate them to start enrolling themselves up for a systematic investment plan. Like trading is injurious to your health, SIPs are extremely healthy for your long-term wealth, right? So I feel that I feel that a remarkable job has been done, and the quality of education, their ability to learn from the asset management industry, from the wise fund managers, listen to them and then take that down in terms of seminars to these small towns is something that has inspired me a lot, and I've become a big fan, honestly, of this community because it is I would say credit to them that 1% household wealth in equities has today reached 4.8%. I really want to let them know that have the faith in the future. Indian markets are likely to be much bigger, and within that the allocation of equities for household wealth is set to double up even from here once again, from 4.8% to 10%. So the size of the opportunity will be very large. If you can get your investors to buy right and sit tight, then they would do a huge service to those managers. I just want to give them a small piece of advice here, that when you're driving a car, it's very important to look at the front screen and drive the car, not the rear view, right? When the rear view for the markets look like bad return, or the rear view for a fund looks like a bad return, do not exit that market, do not exit that stock. In fact, you have to be really greedy when others are fearful, and SIP is a beautiful way to bring down their average cost by participating through the bad part of a market or through the part of a fund, so that you can eventually reap the full benefits in the longer term. I think that ability to ignore the rear view and focus on the front screen is what my mutual fund distributor friends, IFA friends have done, and I'd urge them to continue to do that. And I think that will give the confidence to the retail investors and also help them create enormous wealth in this journey from $3 trillion to $6 trillion GDP.
Yeah, no, super great messages on that one for the distribution community. Lots of nice, simple messages. I actually now want to shift focus a bit, Naveen, on a debate that I'm sure happens quite often within the firm, and clearly you would be part of these discussions. The whole active versus passive discussion that's been going around in the world, and like I said, in India as well. So you all are uniquely placed because not only do you manage active funds, but you're also playing a big role on the passive side. So I just want to understand, your view around all of this, and as a fund house, how do you then play the dynamics between two very, very separate businesses? Because obviously the requirements are quite different. So if you could kind of just take us through the entire active passive discussion, and then how you're playing it within the firm.
Yeah. So we see this as and rather than or a competition. I think they complement each other very well. At Motilal Oswal, the way we've designed this is that more than a decade back, we were very clear that we are not going to be investing in the overseas markets. But we knew that Indian saver has 100% of his savings in the domestic equities. And we had seen the precedent, Karan, of the West and of many other Asian markets where double-digit percentage of the wealth was allocated or diversified in favor of international assets. That brought in our NASDAQ partnership. We were the sole licensee of NASDAQ for over a decade. And that fund has gone on to become more than $1 billion fund. Our next partnership was with S&P 500. And so we bought that product. And over a period of time, we bought more such innovative products which provide access to the Indian savings to invest in America, to invest in Europe, and to invest in the Far Eastern markets through a variety of products. So as you could see, this very neatly complemented with our active strategy. Then over a period of time, we've launched a bunch of domestic products. Now let me explain to you the kind of products that we launched. So none of our active funds are sectoral funds. And we have launched sectoral funds to provide access to play sectors to the investors, particularly the family offices, the wealth counters, the institutional investors, because they have the savvy to understand which sectors they'd like to back, right? Then over a period of time, we've launched a bunch of factors. So we may be doing quality investing, but the value factor may also have its relevance. And so value, growth, quality, each of these factors, we've launched factor funds also. And I think the pathway to innovation to meet the unmet needs of the investor is very long, Karan. So we could keep launching products year after year for the next 10 years. But I think there's a lot to learn from the West, and there are a lot of product gaps. We will always be managing a few products, very, very few products, right? Because in active management, we believe that proliferating yourself with a lot of funds is a recipe to disaster, right? So we want to manage only a handful of funds, focus on them to be able to generate, alpha through the practice of our QGLP investment philosophy. However, these passive funds will meet all of those unmet needs across factors, across sectors, across geographies, and many more dimensions that you will see us launch products, which we have already filed with SEBI over the coming years.
Yeah, so it kind of makes sense in that the sectoral aspects then remain through a certain way of looking at passive, and everything else actively managed.
That's just one of the slices of innovation. Actually, there are 100 ways to slice this over a period of time, and you will see that the West has already done a remarkable job of that, and that's why they have such a large passive industry. And I think in India, that entire opportunity remains for any manufacturer.
Yeah, no, I can relate to what you're saying. So, Naveen, any last messages for the listeners? Given that you've shared so many beautiful instances of what's happening in the industry and what could potentially happen with wealth creation. Any last messages for takeaways?
Well, we are a big believer in equities. We only manage equities. We only invest in equities. And we really believe in the magic of compounding. I've already given you the number. A crore invested when Sensex was born is 800 crores plus today versus 70 crores in gold and 36 crores in bank deposits. I think if you can take the courage to increase your equity holding from 4.8% to 10% and 20% and 30% over a period of time, that will do a lot of good to your process of wealth creation. And you could do that through a good quality mutual fund. You could do that through SIPs or whatever other means that your IFA is recommending you, your MFD is recommending to you, or what you're comfortable with, whatever gives you a good night's sleep. And I think you will retire much more happily and much more wealthily if you were to follow that. The second thing that I want to let you know is that our role models, Buffett at 92 and Charlie Munger at 98, continue to work, right? And they're mentally alert and they're physically still getting to work. So, longevity is increasing, and magic of compounding not just applies to your wealth, but also applies to your health. So equally much invest in that, because the chances that you will touch 100 years of age is very, very high in today's day.
No, I think that's a fantastic message to end the conversation, that you can have all the wealth in the world, but if it's not backed with good health, no point creating all of it. So, and the fact that you've kept your focus on two of the world's best managers, just speaks volumes for the way the fund is being run. Thanks so much, Naveen. I really enjoyed speaking to you, and so many takeaways. Like I said, we should do one more follow-up soon.
Look forward. Thank you, Karan.
Bye-bye.
Bye.